Imagine losing $176,000 over 30 years because you chose the wrong dividend ETF. Not from a market crash, not from bad stock picks, just from fees you didn't know you were paying. This is happening right now to millions of dividend investors, and today I'm going to show you exactly how to avoid this catastrophic mistake. Welcome to the most comprehensive comparison of US versus international dividend ETFs you'll ever watch. I spent weeks verifying every single data point for December 2025, and what I discovered shocked me. Popular ETFs that everyone recommends have expense ratios 5 to 10 times higher than advertised online. The advice you're following might be costing you your retirement. By the end of this video, you'll know exactly which dividend ETFs to buy, which to avoid, and the optimal allocation that balances income, growth, and tax efficiency. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. Let's start with the US Dividend ETF Champions. SCHD has become the darling of dividend investors, and for good reason. It tracks the Dow Jones US Dividend 100 Index with a quality-focused approach requiring 10 consecutive years of dividend history. The fund screens for cash flow to debt ratios, return on equity, and 5-year dividend growth rates. Currently yielding 3.81% with an expense ratio of just 0.06%, SCHD has delivered a 10-year dividend growth rate of 11.25%. This isn't just income, it's income that grows faster than inflation. VYM takes a different approach with 580 holdings. This broader diversification yields 2.6%, which seems low. But VYM delivered 105.5% total returns over 10 years. That capital appreciation combined with dividends creates wealth that pure yield plays miss entirely. HDV uses Morningstar's economic moat ratings, selecting companies with sustainable competitive advantages. With 3.48% yield and 152.95% 10-year returns, HDV proves that quality screening works. The fund weights by total dividend dollars rather than pure yield, avoiding the trap of chasing unsustainable payouts. Now here's where things get controversial. DVY, the iShares Select Dividend ETF, has delivered 178.71% over 10 years, the best performance of any dividend ETF we're examining. But here's the problem nobody's telling you. DVY's expense ratio is 0.38%. Let me show you the math. On a $100,000 investment returning 8% annually over 30 years, DVY's higher fees cost approximately $176,000 more than SCHD. That's not a typo. $176,000 evaporated by fees, compounding against you every single year. Despite DVY's strong historical performance, you'd have been better off in SCHD purely because of cost efficiency. SPYD rounds out the US options with 4.48% yield, the highest we'll see today. It simply selects the top 80 S&P 500 dividend payers with equal weighting. Sounds great until you realize this creates massive concentration risk and volatility that destroys long-term compounding. Now let's examine international dividend ETFs, where yields get significantly higher but complexity explodes. VYMI tracks 1,498 holdings across developed markets outside the US, yielding 4.21% at 0.29% expense ratio. This broad diversification spans Europe, UK, Australia, and Japan, offering exposure to completely different economic cycles and dividend cultures. SCHY is the international twin of SCHD, using identical quality methodology, requiring 10 years of dividend history and fundamental screens. With 132 carefully selected stocks yielding 3.51% at just 0.08% cost, SCHY matches SCHD's fee structure perfectly while providing international diversification. This is the hidden gem most investors miss. IDV, LVHI, and GCOW represent the expensive international alternatives. IDV yields 4.5%, but charges 0.5% annually, 8 times more than SCHD. LVHI focuses on low-volatility international dividend stocks, yielding 4.88%, the highest we'll see today, but costs 0.4%. GCOW's expense ratio is 0.6%. At 10 times SCHD's cost, GCOW becomes impossible to justify for long-term buy-and-hold investors. Let's compare these funds across the metrics that actually matter. Starting with current income, international ETFs consistently yield more. LVHI leads at 4.88%, followed by IDV at 4.5%, VYMI at 4.21%, and SCHY at 3.51%. Compare this to U.S. options where SPYD yields 4.48%, SCHD 3.81%, HDV 3.48%, and VYM just 2.6%. Why do international ETFs yield more? 4 reasons. First, European companies distribute larger percentages of earnings as dividends due to different corporate cultures. Second, mature international businesses have limited growth opportunities, encouraging capital return to shareholders. Third, international ETFs trade at 40 to 50% valuation discounts, which naturally produces higher yields. Fourth, we're in a market cycle where international markets sit in defensive phases, while U.S. markets benefit from technology growth. But here's the valuation story that changes everything. U.S. dividend ETFs trade at price-to-earnings ratios between 15.5 and 18.71. SCHD sits at 16.68, VYM at 18.71, HDV at 15.5. Now look at international valuations. VYMI trades at 8.86 PE, nearly 50% cheaper than VYM. SCHY at 14.27, IDV at 11.24, LVHI at 12.35. This massive discount means you're either getting genuine value or the market expects permanently slower growth. History suggests international markets trade at persistent discounts, creating opportunity for patient investors. The tax story is where U.S. dividend ETFs destroy international alternatives for most investors. SCHD distributes 99% qualified dividends, taxed at long-term capital gains rates of 0, 15, or 20% depending on your income bracket. For high earners, that's a 20% rate versus 37% ordinary income. On $10,000 of SCHD dividends, you pay $2,000 in federal tax. That same $10,000 from international ETFs faces 15 to 30% foreign withholding at source, then the remainder gets taxed as ordinary income at your marginal rate. Combined, you're paying $5,000 or more. That's $3,000 annual tax penalty per $100,000 invested, compounding into catastrophic wealth destruction over decades. The one exception? Retirement accounts where dividend tax treatment provides no benefit anyway. In your IRA or 401k, international dividend ETFs become attractive because you've eliminated their primary disadvantage. Currency risk represents the wild card in international investing. When you buy VYMI or SCHY, you're exposed to euro, pound, yen, and Australian dollar fluctuations. If the euro strengthens 10%, European stocks gain 10% additional return in dollar terms. If the pound weakens 15%, UK stocks lose 15%. VYMI's 25.71% year-to-date 2025 return includes meaningful benefit from currency appreciation against the dollar. Long-term currency movements tend to offset over multi-decade periods, but short-term swings create volatility most investors weren't expecting. So what should you actually do? For conservative income investors aged 55 plus prioritizing current income and low risk, I recommend 70% SCHD plus 30% SCHY. This allocation generates 3.7% combined yield, approximately $3,700 annual income per $100,000 invested, growing 8 to 10% annually through dividend increases. You get SCHD's quality dividend focus with U.S. tax efficiency, plus SCHY's international diversification at matching 0.08% cost structure. The weighted average expense ratio is just 0.07%. For balanced growth income investors aged 40 to 55 seeking moderate risk and growth plus income, go 50% VYM, 30% SCHD, 20% SCHY. This creates 700 plus total holdings across U.S. and international markets, generating 3.2% yield with expected 9 to 10% compound annual growth. The broad diversification historically reduces crash losses by 5 to 10 percentage points compared to concentrated alternatives. Growth-oriented dividend investors aged 25 to 45 prioritizing capital appreciation should consider 60% VYM, 20% HDV, 20% VYMI. This allocation yields 2.8%, but targets 10 to 11% total returns through capital appreciation plus dividend growth. Lower current yield enables maximum compounding of reinvested dividends plus capital gains. For high-income earners in high tax brackets, split your strategy by account type. In taxable accounts, go 100% SCHD for maximum qualified dividend tax treatment. In retirement accounts where tax treatment doesn't matter, go 50% SCHD plus 50% VYMI to capture international exposure and higher yields without the tax penalty. This tax arbitrage saves $3,000 or more annually per $100,000 invested. The clear winner for most investors is 70% SCHD plus 30% SCHY, combining quality dividend focus with international diversification at combined 0.07% weighted cost. This allocation generates 3.6% current yield, while capturing both U.S. and international dividend growth, compounding at 8 to 9% annually over long holding periods. Avoid DVY despite its strong historical returns because 0.38% fees compound into wealth destruction. Avoid GCOW at 0.6% expense ratio when SCHY provides better international exposure at 0.08%. Avoid IDV and LVHI unless you specifically need low volatility features and accept the cost premium. The 3 rules for dividend ETF success are simple. Keep costs under 0.1% for long-term holdings. Prioritize U.S. dividend ETFs in taxable accounts for tax efficiency. Use SCHY, not expensive alternatives, for international exposure. Follow these rules and you'll outperform 95% of dividend investors over the next 30 years. If this video saved you from the $176,000 mistake, smash that like button. Subscribe for more data-driven analysis that cuts through the noise. Comment below with your current dividend allocation and I'll give you personalized feedback. Remember, in dividend investing, what you don't pay in fees compounds into wealth. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.